This market can go a lot higher, and that's contrary to just about what everyone else in the world thinks. And why is that? We think the bears are out of ammo. And what that means by that is that all the bears have all been raging against this market, saying it's manipulated, it's not going to go higher, it's in a range market, it's broken out already. The fact it was even at the point of breaking out should surprise all the bears. If I was a bear, I'd be pretty scared at the moment. You've had just about everything you'd want. You had a collapse in the first half, you had GDP slow down in Q1, you had Brexit, you had European banks arguably implode, and yet the market still goes higher. So the ultimate arbiter of whether you're making money or not is price. And if you're losing money, you're probably wrong. There comes a point where Keynes said that the market can stay irrational longer than you can stay solvent. So the bears are at risk here that this market really rips on them. So with fund managers carrying so much cash, they're going to be getting phone calls from their investors in the next 6 months going, what are you doing? And we think that the bears could find themselves in a situation where they're actually scrambling to buy back the market as it goes higher on them. What's interesting is that normally a bull market ends with euphoria. It's very rare for a bull market to end in complete and abject pessimism. And what we see around us is fellow fund managers have some of the highest cash weightings they've had in almost 8 years. So they're back to levels of the GFC. You also see retail flows. So retail investors have pulled $150 billion out of US markets this year. So clearly there's not money going in, so retail investors are quite sceptical. You look at AAII, which is a survey data set, and the people are more bearish than they are bullish. So putting this all together, it would appear most people are very sceptical about markets. Now, if you look back to 2000, 2007, at those prior peaks, everyone was quite bullish and fully invested and flows were going in. It'd be a very rare thing, it's not to say it's not impossible, for markets to end with complete pessimism. So I think the backdrop's there. At the same time, like it or not, central banks are providing ample liquidity to the world. In a world where you get zero or negative returns on your bonds, a 3 to 4% yield on equities actually looks very, very attractive. So a lot of people talk about valuation being expensive. They are, but compare that to bonds and they actually look quite cheap. And so what you're seeing is money continue to actually climb a wall of worry. And where is some of that internal flows coming from? Share buybacks. So I said there's 150 billion of outflows in the first half. What's interesting is buybacks were 300 billion. So net, there was a net buy order in the US markets to the tune of about $150 billion in the first half. So you may not agree that buybacks add any value. You may say they're debt funded, but the reality is those buyers are still there.